Thanks for getting me started, and I guess I'll jump right in. So we're going to look at some automated options trading technology, something you probably have not seen before. We have a really unique way of issuing trade alerts where you respond with just one touch. We have these professional option strategies using automation. We have an algorithm to pre-select trades and then automatically manage risk and profits. And then we kind of work with people individually as well. So it's not just behind the scenes and purely technology. So we'll go ahead and get you started here. Remember, we're speculating, and with that, there's always risk involved. So do take a moment and look at the risk disclosure. We're not going to read every word of this right now, but you can take a screenshot of that or um, take a picture of that if you'd like to read that for your, your thrilling nighttime reading. But it is important to note that there is always risk of loss when trading. You should be using risk capital when speculating, and that past performance is never a guarantee of future results. Just a little bit about Altavest. We've been doing this since 1997 as an introducing brokerage firm. We've developed our proprietary options technology. We're going to display that and demo that. We traded millions of futures and options contracts along the way. We're registered with the CFTC. We're members of the NFA. We're located in California. I graduated from USC with my business degree. I'm a co-founder of Altavest. And I've had various securities licenses in the past and currently have my Series 3 and my Series 65 license as well. And maybe you've seen us before. We often do presentations and other venues. We love these kind of webinars as well. And you may see us every now and then in financial publications. Here's just the other day, MarketWatch was asking us about what's going on in treasuries and silver and gold and so forth. And so we had some comments there. My business partner, Mike, made some comments, and perhaps you see us every now and then. But with that said, we're gonna get into the presentation, a little more meat and potatoes here. And there are three common hurdles, I think, to trading, and we can pretty much all agree on. But which one of these does resonate the best with you, or most with you? Not the best, but what can you relate to out of these three? Feel free to let me know in the chats there and comments. But how about just confusion and noise? You've got so much contradictory information, conflicting price targets, opinions, narratives, a lot of clickbait. And here every year you got the big major financial institutions give their year-end S&P 500 price target. And this was from January of earlier this year. But you notice you have a range anywhere from a negative 25% return up to a positive 18% return. And okay, that's fine. Everyone can have an opinion, but how would you know which one to pick? I mean, what are you going to go with? So I'm not so sure this is helpful for anyone. It's just, taking up space, I guess, but it really doesn't really add any value to your investing or trading. You can look at technicals and maybe you can overdo it a bit. According to my calculations, the stock market will fluctuate today. So I think we've seen some of these charts like this. I know I've certainly put together charts like this in the past, and not so sure there's value when you overdo a good thing. So really, that's too much information. It would really, be the number one hurdle. And then time. What about the time it takes to sometimes certain approaches to trading take a lot of time in the seat and behind the screen, and discipline as well. So this looks really great, but not many of us have the time to put into something like this. And I think you can probably agree that this person sits full time in front of their computer from the market open until the close, and even after market hours. So that's really not realistic for most of us. That's really the next, I guess that's hurdle number 2 is time. But then 3 would be just emotions. We're human, and our mind gets in our own way. The emotions of fear and greed, we ride that emotional roller coaster and that cycle of emotion where we tend to get overstimulated when we're doing well, and and just as much, if not more so, in terms of when we're losing, we get despondent and capitulate and depressed and so forth. And so we want to stay off of that roller coaster. So we need to control our emotions, as he's saying here. You know, we need to note too that when we're trading, our competition isn't really other people like us behind their screen. It's really technology as our main competitor that runs automatically with no emotion and built-in controls. They take the emotions out of it. You know, algo trading, according to JP Morgan, is 90% of US equity trading volume. That's systematic trading. So I think we see that day by day with these wild swings, these, you know, volatile movements, whether it's in an index or an individual security. So can automation with professional option strategies help us compete in this landscape? We think the answer is yes. So which options market are we talking about? Well, we're going to look at a couple examples here comparing volatility. Here's an index, a stock market index versus an individual stock. You know, here's Tesla versus the S&P over the last year. The S&P is the blue line, and look at Tesla in comparison. It almost makes it look like the S&P hasn't moved at all. So a lot of volatility in individual stocks, especially the larger, well, in fact, any, could be small cap or large cap. And they might move in different directions from each other versus an index. So you have an individual stock, you know, here's Alibaba, you know, out of China. You know, here it is down. And meanwhile, the S&P looked like it was trending sideways to higher, and then it's, you know, tends to rally. Meanwhile, the S&P was lower, and then, you know, you see the S&P moving higher here, and then Alibaba was slowly dropping, and now it's, you know, kind of taking off and leaving the S&P behind. But you understand how that works. Individual stocks have a lot of extra volatility that is not inherent with an index, and you get these headline-based moves too on a specific stock. Remember Oracle a few weeks ago shot up, and again, you compare it to the index and it almost makes it look boring. The index looks like a bore. So why are we going to trade options on the E-mini S&P 500? Well, the reason why is you don't have to choose from 6,000 different securities. We can also note that the mini is actually huge. So it's 2.5 times larger than all of the global ETFs combined. So in terms of average daily dollar volume. So you probably didn't know that, but this is where really all the trading activity occurs in terms of the average daily dollar volume is in the E-mini S&P 500 futures market. And so that means the option market is also big. You can see over 1.5 million contracts each day, and that's from 2024. I'm sure that number, well, I know that number is quite a bit larger, just don't have the updated figure. But before we jump into the demo, we're going to look at some Greek letters. The first, we're going to look at 2 Greek letters in the alphabet here. Delta. It's how much does the option value change with a change in the underlying index? That's the definition, but it also is the approximate probability of an option expiring in the money. That's how option traders view it. So if an option delta is 0.25, that means there's a 25% chance that option would expire in the money. But conversely, 75% chance it would expire out of the money or worthless. So remember, delta is always moving as prices move and as time ticks away. And it is not the probability of a winning trade. So you can't look at delta and just extrapolate your percentage probability of winning or losing on a trade. And theta is the other Greek letter here. It's sensitivity to time. Remember, options have limited life. And theta is a negative number. It equals 1 day of time decay. So if an option premium is 10 and theta is negative 0.05, that means the next day the premium declines to 9.95, and then after that it drops 9.90, it would drop to 9.85, and so on and so forth. And that's just an example of time decay for using theta. And here's a graph of what it looks like. You can see as you get closer to time zero, the value of that premium just drops and drops, especially in the last 30 days, the slope of that decline. increases there. So looking at how an insurance company might trade options, maybe they would do it the same way they do it now, which is essentially they get paid the premiums to assume risk, they sell and manage time, they insure themselves by hedging, they are consistent in their patient and their process, and they just use, really, quite frankly, a lot of math, a lot of probabilities and favorable long-term odds and statistics and actuarials and so on and so forth. So we're going to try to do the same thing, and Wall Street does that as well. So the Wall Street professionals, they're trading multi-leg option spreads, and they use theta decay to their advantage, and they collect premium from buyers to offset their cost. So what does that really mean? There's this woman from CNBC. She has a great interview. I think I put the link in here later, but an option spread is buying and selling different contracts. It's a common way for investors to hedge risk and volatility, and it's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. So what is she talking about? What is a professional option strategy to collect premium? So what exactly does that look like? Well, here's an example. This red line and blue line represents a call spread that is being sold where you collect premium. And this would be selling an out-of-the-money call spread, and you collect a net premium. The red line is selling a call, and the blue line is buying a call. But you still end up on a net basis collecting premium and putting that money in your pocket. And if the market stays essentially, for this illustration, but below the red line, there's a high likelihood that this trade would work out well for you. See, the vertical line here would be your expiration date. So you're selling an out-of-the-money spread, kind of a bearish position or neutral, and even if it could be slightly bullish too. Then this is an iron condor strategy. So it's really taking what you just saw here, selling an out-of-the-money call spread, and you just sell an out-of-the-money put spread at the same time. And you look for the market to stay between those two boundaries. And you can see here the market kind of moving along, and then here's the expiration date on that trade. There's something called a dragonfly, something we developed years ago. And that also collects premium. It's a variation on the condor. And this is what it looks like here. You have the calls and you have the puts, and the net result is you collect premium on both sides of that transaction, and you look for the market to stay within that range. And then what happens is, you can see this big arrow. This is where you get a signal here, this blue square called the RTI. And this says get out of the trade because you've made enough profit on the trade. So you have a profit taking signal, and this can be automated. And I'll show you that in just a second. But so right here is where you get into the trade back here, and time goes by, and then right here you close out the trade, you buy it back, and you notice it's well before the expiration date on that strategy. And we're always going to want to get out of these positions before they expire. And then rookies do this, so we don't want you to make the same mistake that rookies do. But it says here, majority of small-time traders buy the most basic call and put options, which have a much lower probability of profit versus advanced strategies like option spreads. And that's John Foley. He's CEO of Options AI, and he says, everybody in the business knows if you're only buying out-of-the-money calls, you're likely going to lose money over time. So that's something, it's not just me saying it, but it's really just how the options market works. And you need straightforward access to option strategies that Wall Street uses. So absolutely, and that's what we're going to show you here in just a couple minutes. And be sure to stick around. We're going to look at a live trade alert as well and show you how to accept those trade alerts just with one touch, just by touching accept or reject on your phone. So these are professional option spreads. They're created and managed for you with algorithms behind the scenes, kind of the magic working behind the scenes. Pre-built option spreads with Theta Trader is the name of our technology, generating theta trades every day with those one-touch responsive alerts. strategies for any market condition, and then we have the automation for risk and profit with the RTI. It's called the risk thermal indicator, and it's color coded. So it's time now for me to switch screens, and we're going to show you the demo. Okay, you should be looking at my dashboard for Theta Trader if I've switched my screen correctly. And if you're not, then you'll let me know. So up here, you'll see the active trade alerts. So we're going to jump into that in just a moment. Here you have Theta trades for the day, and you'll notice there are bullish strategies and bearish and neutral or non-directional, and they're pre-populated. And we're looking at the E-mini S&P 500, the E-mini NASDAQ 100, and the E-mini Russell 2000. So we're looking at these 3 stock indexes. And then here are your open short or sold positions. They're always in red. Any short spread position is in red, anywhere from 16 to 65 days of time remaining on these open positions. You see the RTI color coding here. We'll get into the details, but these are all doing fine, all these trades. And open bot positions. And you'll notice these here are different colors. And you'll notice that I mentioned earlier, just buying calls or buying puts is a lower probability outcome. So you can kind of see that right here, where these are sitting on some small losses. But anyway, you have settlement price up here. You have your account information. This is all integrated with your Altavest trading account. Theta Trader is our trading technology that we built for our client base. So you'd have an account with Altavest. Now let me take a look here at, we looked at the Condor and the Dragonfly. We'll look at this Theta trade here. It's the 37 days till expiration, November week 3 expiration on the NASDAQ, E-mini NASDAQ 100. And you can see the strike prices are all pre-selected for us. And it gives you, this is your profit potential at expiration, and this is your targeted annualized return. And first thing I do is look at a graph. So you're selling an out of the money call spread and an out of the money put spread. Here's the expiration date. Here's the current price. So that's kind of what it looks like. And you'll notice here all the details. We don't have time to go into all of it, but in fact, let me see here. Does that help you see the screen a little better? And you'll notice the cash required on the trade, 1,700, profit potential, targeted return on cash, targeted annualized return. You've got the settlement value, days till expiration, put risk, call risk, commission, everything you need to know up here. But I will focus right here for a second. So you're selling this 21,400 put, and look at the delta, it's 9.6%. So that's telling you that there's over a 90% probability that this option that you're selling to someone else will expire out of the money. And then look at the call here, 26,800, a delta of 6.96. So over 93% probability that the call that you sell is going to expire out of the money according to the delta probabilities. And then you buy this put and buy this call for protection to cover the position. So these are not naked strategies. These are covered so you know your risk, your maximum risk in advance. And it always defaults to sell because you're selling the Condor. In this case, you're collecting premium. If you want to change the quantity, you can go up or down here. You can see all the numbers moving. So we'll go ahead and, I don't know, let's do 8 of these. You can leave the price here, try to get 12.5 points. And that's it. Just assumes you're filled because this is a demo account. And let me go back and show you a Condor compared to a Dragonfly. So that was the Condor, November week 3 Condor on the NASDAQ E-mini. Let me refresh this here. I think I clicked the screen, my mouse too many times. Let's give it a second, folks. Then I'll also show you here in just a minute, these trade alerts that just came in today, they show up on your dashboard just like this, but they also show up on your phone and email. So we're going to look at a dragonfly. And I'll kind of break down the structure just a little bit here when I show you the graph. So again, this is all pre-selected and it can change every day. Sometimes there's, one theta trade, sometimes there might be 5 or 6. It just depends. And of course, you can look at the different markets as well, but we're just picking the NASDAQ for now. So this is what it looks like here. You're selling 4 of these calls. You buy 3 further out of the money calls and then 1 closer to the money call. And then you do the same thing with the put, same structure. And the key here for the dragonfly is note this one that you buy. It's closer to the money compared to the 4 that you're selling. So it has a higher delta, and that can change the dynamics of the trade quite a bit in your favor compared to a condor. So the dragonfly can have some benefits. I'll show you in just a minute. But when a condor may have a loss, a dragonfly may not, or a condor may require you to stay in a trade longer than a dragonfly. So a dragonfly can mature more quickly. And that's simply because you own an additional bit of protection here and here, and that can pay off when the trade comes under pressure. And you'll notice the same type of details here on the dragonfly. And the margin on a dragonfly is always higher than a condor because you're doing a quantity of 4 calls and 4 puts, not 1. So if you did 2 dragonflies, it would be 8 calls and 8 puts that you're selling. But we'll go ahead and see about doing, let's just do 4 of these. But again, notice the puts and the calls, the delta 9.6 and 7.9. So again, over 90% and 93% probability that these calls that you're selling and puts that you're selling to someone else are going to expire out of the money. So that's the whole idea of collecting premium. And we'll go ahead and place that trade. You can see it just shows up as being placed in this demo account. All right, now let me jump over, and I want to point out we have a really interesting tool here called a trade simulator. And I've put up a couple for examples illustration here. Let me squeeze this down so you can see more of my screen. And here we go. Okay. So we're going to look at this trade here from August 21st with 41 days till expiration. And it's a September E-mini NASDAQ end of month expiration. And we can use these tools to go forward and backwards in time. And you can see the RTI here is green. That means good, do nothing. You see the trade turning profitable. So what you've done here, this sold the condor, you collect money for selling the call spread and the put spread, and you do that simultaneously, and you look for the market to stay really within that boundary. So all is going well. Even though the market's starting to move higher, the trade's still looking good. The green RTI means do nothing, it's good. The trade is maturing, it gets yellow, elevated risk, but still do nothing. And then it turns blue. So it says take profits. You've got 5 days left. Here's the vertical line is your expiration. So the trade has matured enough. You take your profits, you close out the position, and that trade ends up working well. And here is the September end of month dragonfly. So let's compare that. Remember, this was the condor. And keep in mind, we got out with 5 days till expiration. Kind of forget what happens here, actually. And then here, we were able to close out with 6 days till expiration. So you get out just a day earlier. So the dragonfly matured a day earlier compared to the condor. And that's, again, because of the different trade structure. You own this call here, and that can help you in certain circumstances. Let's look at a couple other trades. Here's another condor. And this one here, you wait and you've got 3 days till expiration, and then you get another profit taking signal. So that's your July end of month. And then we'll look at the dragonfly and compare it. Look at here. With 15 days till expiration, you get profit-taking signals here on the dragonfly. So this is kind of one of the differences where the dragonfly can mature much more quickly than a condor and allow you to close out that position and move on to something else. It's a big benefit of the dragonfly at times. Here's another example. Let's look at another condor. You see it's turning yellow, turning orange, more risk, and you can see why. It's getting closer to getting through your boundary. And then it finally turns red and it says, take your loss. So you end up taking a loss on this condor. We don't want to just show, one winner after another, although they are high probability trades. But so that's the May end of month condor. Now, what about the May end of month dragonfly? So obviously the same market movement, and the trade is turning yellow, higher risk, and it turns orange, even higher risk, but then you can see that there was no signal to get out. It didn't turn red. In fact, it turns blue. You get a profit-taking signal with 2 days remaining. So the dragonfly paid off quite well here and kept you from taking a loss compared to the condor. Because again, you've got the sold call and the long call here as protection, but here on the dragonfly, you've got the sold calls, but you have a long call that's below the strike price of the others that you sold. So the delta is higher and it's offering more protection. It gains in value more rapidly than the four that are higher strike price. So that's a huge benefit of the dragonfly. We love using the dragonflies. And let me point out too, we don't just do non-directional strategies. I know we talked about that in the slides in the presentation, but Theta Trader is built to harness premium collection, of course, and do non-directional strategies, but you also have bullish and bearish strategies available here as well. And I'll show you that in just a second here, right here. So here's something called a bull hedge. And what you do here is, if you're bullish, maybe you buy an out of the money call spread and pay premium. That's called a debit spread. But to pay for it, you sell an out of the money put spread. And you can often do these for even money or no cost. So here's an example. The market rallies, and this trade would do well. Obviously, if the market rallies, because you own this call spread, it's going to gain in value if the market moves up rapidly enough. And you can see here, the blues are all profitable. I forget where it goes, but anyway, you get the idea. That just wanted to point out there's some examples there of how that works. And let me see here. Let me go back and I'm going to show you the trade alerts now. So if we get a trade alert, you'll see them on your dashboard and you'll click to view them here. So here they are. Here is one trade alert for today. And you can see here, this is the butterfly call spread. So this is a bullish position. You sell 2 calls, you buy one further out of the money and then one closer to the money. And here's the really cool thing about these alerts. Notice the quantity is 15. Well, that's pre-selected for you and your account. Everything is customized and individualized to you and your account. Now, if you want to lower the quantity, you can, and lower the risk. We'll do 14 of these just for the sake of argument. And you'll notice the pricing here, the position, and how much money it's going to cost you to place that trade. And you can go ahead and accept that trade just that simply from your dashboard. Here's another trade alert. This is another dragonfly here, came in today. And again, you can change the quantity. You notice as you change the quantity, the numbers go up or down as well. We'll go ahead and do 6 of these and we'll go ahead and accept it. It's just that easy. So I wanted to point that out. And notice too, we have something under my account called TradeScope. That's our daily research. That's available to all of our client base, where we give some simple technicals, but also a market outlook and kind of an overview of the global macroeconomic environment. And let me show you how to automate things. So you go under My Account and you go to Settings, and this is where you automate the risk manager. So when it turns red, like you saw, the orders will be placed for you to close out those positions. And you can customize it if you want a lower threshold for risk, but you just have more frequent losers that way. It's not always better or worse, it's just different. Or you could change it and go all the way down to say 25, but I just leave it at 50 for default. And then you click Save Your Settings. And same thing with your profit directive. Activate your profit directive, and then ThetaTrader will automatically close out that position for you and place that order for you when you reach a profit or a risk target, whichever comes first. So that's the beauty of sort of hands-free trading with these sophisticated strategies. Then we've got a great help file here as well. And if you want more details on the color coding, it's all right here. Won't get into it, but just wanted to point out. And then also there is a whole thing on video tutorials on ThetaTrader, all available here in the help file. And then also we have an education package here, kind of a master class with futures and options education. So it's a great resource for clients. They really like that available to them there. All right, so that is a brief overview of the ThetaTrader platform. Now let me show you what I think might be the best feature of all in terms of how those trade alerts work. And those one-touch trade alerts you saw in the platform there when you log into your account, but you don't even have to do that because you can just receive these on your phone and you just touch your screen. You don't even have to go into your dashboard. So here's what happens. You'll receive a text message, and then it will pull up the screen for you. And you'll see a graph of the alert. You get an explanation of the alert there. It was good to have a visual. This happens to be a dragonfly. And you notice the quantity is pre-selected for you and your account. And if you want to reduce it, you could, but you cannot increase the exposure. And everything's calculated for you in terms of how much premium you're collecting and what the margin requirement is. And you just touch accept, and that's it. That's all you have to do. So those alerts are really user-friendly, to say the least. All right. So let's show you how to get started with ThetaTrader and a ThetaTrader software package. So you get everything we just talked about and just demonstrated: the theta trades, the risk thermal indicator, the color coding, and the trade simulator. So it's a great tool. All that software available for $3,588. That's the value on that software. But it also includes the trade alerts. So you've probably never seen alerts like this before. And it's integrated with your account. You just receive an alert on your phone, you touch accept or reject, and that's all you have to do. And then ThetaTrader will also track that position for you automatically once it hits a red or a blue RTI, whichever comes first. So you see the value there with the ThetaTrader software and the trade alerts, over $8,000 value in all that technology. But there's also us. So we have real people behind the scenes here. We are all experienced and licensed, been doing this for many years, and we'll work with you one-on-one. We'll do screen sharing with you, whatever you want to do to help you reach your goals. And how much does coaching cost? I just pulled this just the other week here. Comprehensive packages with experienced mentors range from $5,000 to $15,000 for 6 to 12 months for trading coaching. And really, I don't know, $10,000 value, 20. I've had people tell me they've spent $25,000 on coaches and knowledge and education, even $50,000 on systems. And what we're saying is that's all part of your ThetaTrader package. So valued at over $18,000. And just want to point out too, don't forget the proprietary research available to you on a daily basis as well. And then that futures and options masterclass, I showed you real briefly where that's located in Theta Trader as well. Some of the chapters here that you would have access to. You can learn about stock index option spreads and then some of the advanced strategies. So all of that, the education valued at almost $2,000 with the research and those online tutorials we talked about. So you get the Theta Trader software, you get the alerts, you get the private coaching, you get the education, you get all of that valued at over $21,000. So we used to offer all this in live sort of in-person presentations and seminars at $39.97. And of course, that's not what we're going to charge you. We're going to do even much better than that. Great value for this professional options trading package, this Theta Trader membership, and it's a lifetime membership. It's only one payment of $597. And there's the QR code, so please take a picture of that or just put your phone up there and take you right to the order form page, or you can go to cf.altavest.com/TT for Theta Trader. You can take a picture of this whole page too. That's my direct phone number and email if you have any questions. And there's a 30-day money back guarantee on that. So really, if you change your mind for whatever reason, that's fine. And then if you want a free membership, if 30 days you fund your trading account with 100,000 or more, you'll get a 100% rebate. Or if you fund your account with 50,000 or more, you get a 50% rebate. So we'll be glad to do that. And just keep in mind, big advantages in trading these E-mini options, large market share, densely packed strike prices and expirations. So you get the granularity and the coverage you need. So what that means is the algorithm is going to find the strike prices it needs, these out of the money calls and puts that it needs to build these strategies. So you're not going to find that with the vast majority of stocks or ETFs, that's for sure. The volume is just not there. Superior execution, according to the CME group, versus the SPX. ES options offer a cost savings of $4 to $15 per contract. So you get those tight bid offer spreads is really what that amounts to. And that's important when trading options in particular. So remember too, these are covered spreads, so no unlimited risk, and that means no margin calls. So the way we trade, you never have a margin call. So this joke here I kind of like. It says, who is margin and why does she keep calling you? So you want to avoid those types of calls. So that's a big advantage of trading these covered spreads. There's no pattern day trading restrictions either when you're trading.
Erik, I think we lost audio. Erik, if you're there, we're having trouble hearing you right now. Erik, we still can't hear you. I'm sorry. Maybe sometimes go into the Hi, Erik. We're having trouble hearing you, I think. You might need to sign in and out or mess with the your audio settings. Eric, I apologize, but we can't hear you right now. Thank you, Greg, for your comment there. Eric, if you could hear us, we are unable to hear you. Eric, we're unable to hear you. Can you say anything right now? If you can hear us.